Awesome. Well, I feel like we've got our attendees up here. It's time to jump in. Sorry, Finn is a ghost today, apparently, but we're joined today for our first session. We've got Finn Price and Brennan Volpe who will be speaking on tax planning through every stage of life. And our first speaker is going to be Brennan. You can see he's joined us here today. To give a little background on Brennan before we get started, he grew up in Cary, North Carolina. He's married to his wife, Shannon, of 15 years, and they've got three kids. And they have their baby number four coming in October, best month. That's also when my birthday is. He received his BA in Business Management and Finance from Utah Valley University. And Brennan has been licensed since 2016. He started Citadel Financial Planning in 2022, where he works now. He enjoys camping, reading, and playing video games with his kids. So without further ado, Brennan will let you take it from here.
Awesome. Yeah. So welcome. It's great to be here with everybody today. Brenan Volpe, Citadel Financial Planning. And today we wanted to talk about something a little bit different. Our practice, we've got a very young book of clients. We've a group of younger advisors. And so wanted to share some of our experiences and some of the successes we've had in tax planning across all the different generations and life stages of a household that you might be working with. Like many of us, I found myself early in my career kind of making a lot of assumptions and kind of ignoring the younger generations when it came to tax planning. Just, oh, they're in a younger, early stage of life, not making as much money, not paying as much taxes. So not as much of a priority of a conversation there. But the last few years, as we've really dug into Holistiplan and gotten much more in depth in our tax planning with our older clients, I find myself, doing conversions, doing all of these different things and saying, dang, I wish I would have done this with this client 5 years ago, or dang, I wish I would have had this conversation, 10 years ago and just started doing this earlier while they were in those lower tax brackets and all of those, should have taken better advantage of it. So what we're finding is these are great clients. They want to, once we've do the education with them and really talk about, all right, let's talk about this year. Let's talk about, marrying that with our retirement planning conversations that we're having and where your contributions going and what's that going to do for you 30 and 40 years down the road. They're very focused on this stuff. They are invested in getting things set up the right way, and very willing to take advice. These people are smart. They I'm not talking about the ones. I'm talking about my own generation here, so I'm going to say some positive and negative things here, and I'm allowed to do that. But we're not talking about the ones with drowning in student loan debts and don't have any idea what they're doing with their finances, but plenty of high income, very focused, people in their 20s, 30s, and 40s that very willing to take advice and implement strategies today that will make a big difference down the road. For age 20 to 40, these can be very difficult clients to work with. At the same time, just when we talk about things in retirement, that's so far away. They have a lot of other goals in between now and then, which, we want to make a plan for everything top to bottom. So really focusing on education, keeping things simple. You're going to make a plan with them today, and then they're going to change jobs a bunch of times. They're going to get married or start a business. Things are going to change a lot more often, generally speaking, with this age group. So it's not necessarily about making the perfect plan for forever. It's really just about educating them. And for most of these people, if you're working with a client, one of your kids' clients or just a high income younger person, you are their education, their financial education. You are the person that's going to be teaching them what their contributions mean and what the tax strategies. You're going to be the first person really having those conversations with them. But another just tip is you really can't tell them anything. You have to show them. You have to show them in holistic plan. You have to show them in in your other tools and make it very personal and real to them. Really focus a lot on contribution strategies. Just where are you planting your seeds today? That's going to determine what your tax situation is going to be along the way and ultimately, down the road. We talk about Roths a lot with this cohort. I talk about it, kind of as a joke, but kind of not really. We are trying to indoctrinate them. We are trying to make them understand Roths, this one concept so well that because once they do, it really helps them realign all of their other priorities and investment decisions. One of the tough parts about this age group is that they're very easily distracted, want to get rich quick schemes and the meme stocks and the crypto and all of the things that they're seeing out there. But if you can focus them on a couple of just core bedrock things, like a Roth IRA or their Roth 401ks, those types of things, they can understand the concept, and it will really help them in prioritizing, balancing out all of the other things. Yeah, we want to buy a house. Yeah, we want to retire someday. We want to do all of those different things. But if they understand kind of these core principles, it makes a massive difference. A lot of them, I mean, it's tough when you start working with somebody and they've had option to do their 401k or to participate in ESPP or to do all of these other things, and they just haven't taken advantage of it for 5 or 10 years, and so much missed opportunity there. So have those conversations right at the beginning. What are you contributing to your 401k? Do you have the option to do a Roth 401k? Sometimes you'll have that conversation, but go back and verify it. Make sure that they're going to, actually set it up and take advantage of all of these different things. Get in depth, ask questions. They might have a 401k, but they also might have a rental property or a crypto account or different things that you're not used to asking those types of questions with your retiree clients. And so just, building a little bit of a different program for those clients to, really dig in and make sure they're taking advantage of everything that they have available to them, whether they're a business owner or an employee or, what have you. So yeah, I have a case study example. We have a client, kind of a good example. He was already doing Roths pretty heavily before he started working with us. Once we went through the whole retirement planning, just, hey, here's a quick view of what that would look like over the next 30, 40, 50 years if you kept really focusing on Roth. And once he saw that, he was just like, okay, that makes sense. I'll just max out my Roth every year for the rest of my life and never pay taxes, I guess. And we're like, interesting. Like we're balancing some level of traditional and Roth, but and his circumstances very well may change and be in a higher bracket where traditional makes sense. But being able to show him, not just having a general conversation about what a Roth is, but very specifically in holistic plan, showing him you maxed out your Roth 401k, just so this is what it would have saved you if you had put that same 23,000 in a traditional 401k. And are you comfortable with paying that extra $5,000? Yes, great. And just making it very real, making it very personal to them. Now we're talking about it as we are investing $5,000 a year into our tax bill, because we've shown that that's going to save us a whole lot more than that down the road. And so, I mean, again, this is a young client. It's kind of hard to do 60-year projections and everything. But when we pull this up in our planning software, eMoney, it's a very different retirement planning situation than what we're doing for our clients who've got, millions of dollars in their IRAs. We get to this point where he retires at age 58 years old. And literally every single thing he's got is in Roth format. And so he can pull as much out as needed with basically no taxes. Who knows what a lot of things look like way down that road, but again, if anybody who's used to using these programs, this is not what our other retirement plans look like, either on the cash flow or the retirement situation. And just how many doors that opens to be able to take as much money as you need at any year you need it without having to worry about taxes at all. Very, very different conversation. Then we get into the 40 to 60 age bracket, where a lot of us are doing some level of tax planning with these people, and a lot of the same characteristics from the 20 to 40 group kind of apply here, especially the earlier side of this. But in general, they're going to have higher income and more cash flow. They've paid off some of those debts they've got in college and so forth. They also want to live their life a little bit more and feel like they deserve to have the nice house and the nice car and all of that too. So it's always a balancing cash flow conversation. But generally speaking, they're willing to invest in some of these bigger strategies and ideas that are going to help them save money today, because these are their highest tax paying years. The donor advised funds, trust strategies, Roth conversions. We try to use this range calculator in Holistiplan every year with every client, just to have this conversation of, if we could convert $4,000 without bumping you up, or 12,000 or 20,000, we should do that. And now I've seen a big change. We just started using Holistiplan 3 years ago. The first couple of years, it's kind of like building those connections in their head. But now they've seen this chart year after year. It makes sense to them. And okay, great. We want to max out that 12% bracket, or okay, we want to max out that 22% bracket. How much should we convert? We mix it with all of the other stuff. And it's just a much, I mean, we've seen the amount we're converting each year go up every single year, from very little 5 years ago to over $1 million but across our book. And that's just going to continue to accelerate because the clients get it. They understand the principle, they understand why, and we can show them with very, very close, accuracy, what that would mean for them in real dollars and cents. Yeah, so the next cohort I wanted to talk about, they can really be in any of those age ranges. It tends to be more often people in their 40s, 50s, and 60s. But the business owner crowd, there's a lot of opportunity here, but there's also a lot of challenges. As a business owner myself, I can tell you, I'm really, really good at this one thing that I do. And all of the other parts of it is overwhelming. And these people can be very hard to pin down, very, very hard to coordinate with. You can ask people how much money their business is making, and I mean, it's like you're talking in a different language to them. They have, I mean, not even a close guess, usually. And so what we've found is, if they have a good CPA, if they have a good bookkeeper, and if the business owner is organized, we can do a lot of really great tax planning. Almost never is that the case, though, that all three of those things line up. And so we try to really do a lot of education that probably should be done by the CPA or the bookkeeper or other places, but just doesn't happen most of the time. They know they need to track things, but they don't understand how important it is. So just really emphasizing those things. Hey, call your bookkeeper back, get your books clean, have those meetings, because I need to know what you're trending towards. We need to know what we're working with. And it doesn't help us to know next summer when you finally get around to it. It's way, way too late. And so totally resetting their brain to start doing their taxes and their bookkeeping throughout the year, instead of that being a next year thing, is a big shift. Because once they can just provide you with clean books every quarter, and we can have that meeting and understand what we're working with, it's almost impossible to get them to pull the trigger on doing some big strategy or conversion or donor advised fund if we do not know what those numbers are, or a very good estimate. So really talking through a lot of the different pieces that affect a business owner, tax planning, bookkeeping. Do you have the right people on your team? Do you have the right pieces? You know, are you paying yourself the right amount of salary versus your K1? Are you set up in the right structure? Should you be an S corp? Should you be an LLC? Conversations that just aren't happening a lot of the time, unfortunately. And so I'm not a CPA. I'm not giving them advice. I'm just trying to educate them on what the options and pieces are so that we can then coordinate with their professionals and ask some questions that will, spur those conversations to happen. Um, yeah, these are just some examples of some of the slides and education we use with our business owners to get them to understand how important this is. We really try to true it up at the end of the year, but after doing this for a couple of years with people, we're getting into a rhythm to understand their business, their income. Do they have a spouse that also works? That, is their income stable, or is it variable as well? I mean, how many moving pieces do we have that we're really trying to juggle all at once? Shocking amounts of our clients are set up in the wrong business structure. You would think that that's just something you would do right the first time and it would stay right. But I mean, an incredible amount of them are an LLC that should be an S corp or the other way around, and they're not paying themselves a salary or not paying themselves the right amount of salary. So just again, education pieces that help them visualize and understand their own situation better so that they can, hey, what if we go talk to your CPA? What if we split you out into an S corp, and hey, this could save you a whole lot of money in taxes. Again, not really my job to have that conversation, but also I'm not going to let a client go through with the wrong structure and just because their CPA doesn't build that into their routine to kind of have those conversations with them. And yeah, I mean that's really all I had. It's a lot to kind of cram in there, but so many different opportunities and things that we've learned by working with these younger clients, because there's just not as many moving pieces with a retiree client. That's more of a set it and maintain a plan, whereas you're kind of always going back to the drawing board and starting from scratch with the younger generations a lot of the times, which is a lot of work, but also provides a lot of cool opportunities to make those long-term impacts for those clients while they're young.
Yeah, thanks, Brennan. I love what you had to say about like laying the foundation for those younger clients and being like proactive and tactical about their planning. Um, as someone else in that same generation, a tax-free retirement sounds pretty good. So, yeah, thank you so much. That was great.
Absolutely.
Um, Up next, I would like to welcome Finn Price, our next speaker. Finn is from Auburn, Alabama, where he grew up and attended Auburn University. He's been with his firm for 6 years and has been licensed for 3. Um, he enjoys solving puzzles and working on assembling different projects like cars and houses. Super, super impressive. He also enjoys teaching others about finance and tax planning at Auburn University, where he routinely hosts classes for his retirees. So welcome, Finn.
Hello, hello. Thanks for having me. Yeah, of course. I'm happy to be here. Brendan, I think if you allow me, I can share my screen now. Yeah, yeah. So I will be talking in tandem with Brendan about planning for retirees. So, he covered the first part, which was great. It was an excellent presentation. It talked a lot about when you're at that stage in life, because there's a lot of people and they need help. Like you said, there becomes a point where it's sometimes too late to make decisions. So the earlier you start, the better. We at our firm, Railroad Investment Group, which is located in Opelika, partner town to Auburn, spend a lot of time on tax planning, right? My partner, Blake Henry, the founder of the firm, came to me a couple of years ago and was like, hey, tax planning is the future. Like, this is what we need to focus on. So we started learning as much as we could. A little bit into that process, we found Plan and really hit the ground running. We are such big fans of Plan. We are such big fans of the tool, how easy it is to use, the results with clients. I always tell people if there's any tool that I would recommend to any advisor, it's Plan, right? It's been a big reason that a lot of the new clients we've brought over and a lot of the existing clients have converted to advisory, whatever planning fee we've decided to include. It's a big part of our plans. So when we walk through planning for retirees, what I really wanted to talk about was the prospect client planning cycle, right? So when a prospect comes in, right, what does that look like? How do we start to use Plan in that process? Then what does the plan look like when we sit down with the client, when we walk through that tax specific plan? How can you add more value with Plan, add more credibility to your situation as the advisor? And then ultimately, as we all like to do, how do we make our client's life easier, right? And if anybody here files taxes, which I would have to guess every single person on the call does, tax season is no fun, right? Especially for our clients. So if we can make their job easier, it is one of the biggest things that they remember when you are adding value. Okay, so ultimately, right, as a tax-aware advisor, that's how I position myself with prospects, right? So how do I become that tax expert in their eyes? So what a prospect does a lot, and with the ones I'm bringing on, is they attend a class that I teach at Auburn University. The topics are either taxes and retirement or full-scale retirement planning, right? I'll give you a hint. In the full-scale retirement planning, we spend a good amount talking taxes, right? The one thing that we talk about with clients is no one likes overpaying taxes, right? Don't tip the IRS is a common saying I'm sure a lot of people have heard, because we want you to pay every dollar you owe, but not overpay, right? The biggest thing to point out to retirees is saying, hey, everything in retirement, all the distributions, all the investment changes, right? When it comes to your financial plan, it's all interconnected and it all has a tax component, right? There's a tax consequence with the transactions and the changes you make. So you ask them, you say, hey, when's the last time your advisor requested a tax return? Not just that, but they actually did a deep dive review into it, looked into all the details. Well, I don't think they've ever done that, or I don't know if they've ever done that. Well, that's normal, right? But don't you think it would be a good idea for them to be very aware and review your tax situation before making recommendations? I mean, that's a pretty obvious answer. The reason why is, distributions from IRAs versus Roth IRAs, picking or choosing different investment types in different accounts, right? How does your tax efficiency as a whole look? It's all part of what tax planning is as an advisor, right? It doesn't have to be super complicated Roth conversion scenarios and all this, right? If you're making changes or recommendations to an account to a person, there could be tax consequences, right? So what the client does is they come in for a one-on-one session after the class. They bring their pile of documents, right? We have a good conversation. I get to know them. I get to collect documents, right, on their situation. And then what we do is if we decide to work with them and they decide to work with us, because it's a two-way street, right? We upload the tax return into Plan, right? So what we generate is the tax report here. So I'm sure if you've been on any Plan webinar or you use the tool, you've seen this tax report. This is money, right? This is a great report to show. We give this to clients every year, right? As they come in at the beginning of the year, we collect the return. It's a good report to have, and it's very easy to generate. So I like to sit down with prospects. They've given us their tax return. They come back in. When they come back in, before they ever engage us, we're going to walk through a one-page plan, right? And with that one-page plan, I'm also going to have this tax report handy. I want to really show them how much of an emphasis we spend on taxes, right? I want to show them, hey, I'm an expert. Here's how much we review. I'll tell you one thing, it's a lot easier to look at this tax report than it is a tax return, right? Tax returns are not very easy to walk through. It's hard to walk through with the client. So a big thing I like to point out is saying, hey, here's your total tax, right? Here's how much tax you paid. At the end of the day, not everybody sees how much tax they pay, right? There's a lot of withholdings, there's a lot of prepayments. So pointing that out is always good. Looking at marginal, right, versus average. So, hey, you're in a 22% bracket in this scenario, but on average, you're only paying 11%. It's pretty good. Then looking over here, right, a lot of the times we want to look at qualified ordinary dividends, long-term, short-term gains, carry forward losses. This is where a lot of the investment management comes into play, right? As advisors, as investment managers, we take a look at this. There's a lot of changes we can make to help this situation. Also pointing out, hey, here's where you're at when your bracket, here's your ordinary income, you're right over into the 22, pointing out capital gains, brackets, and really too, focusing a lot on the IRMA brackets, right? There's so many brackets that people don't realize exist, right? Phantom taxes that exist where, hey, in this client situation, when I walk through kind of what the plan looked like, they have to pay in 2 years higher premiums on their Social Security and their Medicare, right? So their premiums are going to significantly increase, and they weren't aware of that, right? So making people aware, showing them, hey, I'm a tax expert. Here's everything we're looking at. It is just the easiest way to start to build yourself as a professional, right? The big thing is too, by having that return, by having that in HALISTA plan, it allows you to go through their situation with the scenario tool and put together that one-page plan, seeing what you learn through HALISTA plan, right? So here's an example, right? So looking at, for this client, with one of the sections, income taxes, right? So harvesting gains and losses based on market and tax position, right? That's a big part of the planning. They weren't doing it strategically before. Optimizing, right? After tax returns, they weren't they were currently overpaying on taxable interest and capital gains. They were giving to charity, but just writing checks out of pocket. So, hey, let's look at charitable giving, right? How do we want to do this? They had actually done an IRA contribution the previous year with their previous advisor when they had no earned income, right? They didn't have the ability to do that conversion. Talking about, hey, we want to give to grandkids. What's the best way to do that? Looking at, hey, are we going to do Roth conversions? And I even included Roth contributions because in our discovery, they had mentioned that the husband was going to work part-time for his local church. So if he's working part-time and he's getting W-2 income, that's something where we could do partial Roth contributions, right? And then ultimately just saying, hey, every year we're going to do an in-depth tax analysis, right? So showing them, hey, here's what we're going to do. These are all key points to say, hey, here's what we're looking at. Here's a lot of things, but it's not giving them specific step-by-step instructions on how to execute or exactly the numbers on what to do. So we like to say, this is a taste, right? I don't want you to pay me any money without you seeing what you're paying for. Here's a taste on how to see that. So the prospect comes in, you build this trust, you build this case, they become your client. It's amazing, right? So then you spend a lot of time going into the specifics, right? You are now showing them the numbers, showing them the steps, and helping them execute, right? Coordinating with their CPA. So I'm going to go back to the tool here, show the scenario analysis, right? The big thing with the scenario analysis is using this for walking through the client situation, right? So you get the 2024 report. And what I like to do is I like to run a 25 base case, right? So base case, here's your situation. If you didn't work with us, you had no tax planning, here's what it looks like, right? So updating the wages, right? Updating, their losses, right? So this is a big part of a conversation when they came in, was they had transitioned advisors in 2024. The other advisor they had hired didn't work a lot with non-qualified assets and actually liquidated a lot of old legacy mutual funds they had with significant capital gains, right? So they paid significant capital gains and tax on those capital gains last year or in 2024 when they didn't need to, right? They were completely unaware of it until they got hit with a $20,000 plus tax bill, right? And so for a client whose income is typically $80,000 less than that, it was very, very big, right? The other big thing this year is they told me, in the state of Alabama, one of the biggest parts of our state is timber and lumber. It is a huge industry here. And so we have a lot of clients who own timber land. And he told me, hey, I'm gonna have a profit of about 59,000 this year from harvesting timber that I was growing, right? So we add that in, they're using the standard deduction, and then we can go down and say, all right, well, in that case, here's your tax, right? Here's your estimate, right? Let's review your CPA. Let's double check. It's just an estimate, right? It's not guaranteed, but it's, giving you an idea. So then we run the other scenario to say, all right, well, let's do some planning. So in this client situation, they had a lot of taxable interest. So let's say instead of having that taxable money market, let's move to tax-free bonds or a tax-free money market, right? Don't pay unnecessary tax. Let's look at your IRAs. They both had annuities that they had started taking income from. These were IRA annuities. They were taking the income. It was above the required minimum distributions, and they didn't need it. They didn't need the income. They have this huge taxable account, right? They don't need to have that monthly coming in. It was above what they were already spending. Luckily, those were purchased, 25 years ago, so we were able to move them to an IRA, stop the distributions that were unnecessary, causing unnecessary tax. And then they told me they gave to their church every month, $1,000 a month. Well, what they were doing was literally taking the money from the annuity, right, the distribution. They were paying tax on it and then giving that $1,000 to the church. So I said, well, you're paying that unnecessary tax. If we just do a QCD because you're over 70, right, you can now just give it straight to the church and not pay any tax, right? You don't have to write a check out of pocket, reduce your tax bill. Go down, talk about, hey, tax loss harvesting, doing that on a regular basis, getting that maximum $3,000 in losses that they could get, obviously including the farm income because I can't change that. But the other big thing was, hey, you don't itemize right now. Since you have this year, 2025, where you have this out of the ordinary income from the sale of timber. If you're unfamiliar with timber sales, it typically happens every 25 to 30 years. So in this client's lifetime, it probably will not occur again. So the big thing was saying, hey, let's take those legacy mutual funds that you've built up that are distributing capital gain distributions that you have these huge capital gains on, and let's donate some of them, right? Let's give some of them to charity, right? So then you have this bucket build up. We can put it all in a DAF, a donor advised fund. You've got the credit all in this year, but then you've got, the rest of your lifetime if you want to give to charities. So what this bucket is for is it's for all the charitable giving they want to do outside of their normal gift to the church, right? If they want to give to the Humane Society, if they want to do a special project, right, at the church, this is what that bucket's for. Doing that this year allowed them to also itemize the giving they had already done, as well as take advantage of the local taxes, right? Here's a big thing now with 25 and the tax code change that we like to point out. By doing this planning, out of the $12,000 additional deduction they could have gotten from the new tax law, they were only going to get $6,300 before. Now with the planning, they're going to get they're going to get $7,600, right? Which is, $1,300 more, which is a big chunk. But that's the big thing with this new senior deduction with the phase out levels. There's a lot of people who are very close to that phase out. So showing having the holistic plan tool be able to calculate, hey, here's how much their deduction is going to be based on their income. It's super convenient and it's been a big part of the planning we've done this year after the tax law passed. So you come down here, right, and you can show them, hey, here's the results, right? Here's the difference. Right? So going to this client and saying, hey, on an estimate based on our scenarios, no guarantees, if everything is aligned with what we projected, we could save you $10,000 almost, right, or more in taxes by doing these planning items. That's a big value add, right? If you're charging a client a fee and you can say, hey, here's what I'm dollar for dollar saving you, it is huge, right? The part two that I'm going to talk about is really going through building that trust further. So adding the value, right? Having the property and casualty tool is huge, right? So we collect the property and casualty insurance, upload it, right? The biggest thing I'll say about this, because I know I'm running a little close on time, is uploading that and then giving them the report and then offering to go to their property and casualty insurance provider with the report is for you, it's saying, hey, I look at every part of your plan, right? Even if you don't, sell property and casualty insurance, you're still looking at it, right? There's no financial benefit for you doing that, right? It's just you going out of your way to add value to them. It's been a huge way to just continue to build trust and continue to add value to our clients. The last biggest thing, right, is double checking the tax return, right? So I know a lot of people have issues with relationships with CPAs. The one thing that we love to do with our clients is use Holistic Plan and build the tax letter, right? So outline, hey, here's the tax documents you're going to get from us. Here's the direct rollovers we did. Here's the charitable distributions from IRAs, right? Here's the donor advised fund contribution. Here's the cost basis. So giving this to them, giving this to their CPA, giving the CPA digital access to their tax documents to make their life easier, builds trust with the client because it makes their life easier, builds trust with the CPA because it shows you want to work with them. And then ultimately, right, it helps them keep organized and accessible, right? Because then what you want to do before they file the tax return, if you're doing all these planning items, is request a copy of it, right? And review it beforehand. Go through the checklist, make sure everything's correct. Because I guarantee you, if you're doing all these planning items with retirees, there's going to be a lot of items that are not correct, right? And so you want to double check and work hand in hand with the CPA because look, they've got a hard job. They're filing thousands of returns a year. It's going to be hard to make sure every single thing is correct. And that's where adding that value to the clients is huge. So when we catch mistakes for our clients, it is the biggest value add to them. It builds the most trust in them and allows them to rely on us as their number one professional above everybody else. I will stop my share there, but that is the gist, right, of going through that client process with the retirees, building that relationship with them, and really building that trust and that value through tax planning.
Yep, Brennan or Finn, thank you so much. I looked down at Brennan's screen and said that. Y'all did great sharing kind of your process with your very different clientele and how you guys approach those clients very differently. I know we had quite a few questions in the chat. So we've got some time here for Q&A. So if people have questions, you can send them in the chat as well. But one of the ones I saw pretty frequently was, what other tools are you guys using in conjunction with Holistic Plan? It looks like you guys kind of have more than just one tech or piece of technology in your tech stack. So they want to hear a little more from you guys there.
Yeah, we use eMoney. That's our main planning software. Some people are using it very regularly and do all their, budgeting and everything in there, but try to do all of our retirement planning scenarios and kind of marry that with Holistic Plan. And then on the tax planning side, I mean, those are really the main tools. We have some of our own tools and spreadsheets and things that we've developed to help us track people's, process of pay stub and kind of help forecast what the end of year balance is going to be and tracking things for business owners and kind of some internal processes and tools that way.
Yeah, and I would agree, right? We use a Holistic Plan, right? The reports are so clean, the tools are so clean. We use that a lot. We use a lot. We use Right Capital some, right? We use a lot too of customized reports we built, right? Trying to make our ultimate goal with retirees a lot of the times is trying to make things as simple as possible so then they can understand it, right? And then actually execute, right? Our goal is if we're going to make a recommendation and it's not executed, then there's no point in making the recommendation. So I'm trying to make it simple. It allows us to really build out a lot of custom, Excel, Word, PowerPoint. We use a lot too, like Precise FP is a good tool. It's you can fill out the profile sheet, but we actually create a document upload form. So it's very easy at that point using that to get the CPA to upload a tax return or get a client to upload a tax return. That's a big part. I saw a question in there about how to get the tax returns. That's a really good way. And again, building those CPA relationships is huge because it really helps make your process easier, right? And if your client doesn't want to bring you your tax return as being difficult about it, then it can be a red flag because you're trying to save them as much money as possible, right? Typically, when you say, "Hey, I'm going to save you money," they come running, right?
And yeah, that is a good point. We did just start using a tool called Box which has allowed us to put a permanent encrypted upload link like in our email signatures. And so we've been telling all of our clients, just anytime you need to, it's in this email, go ahead and upload it, and just make it as easy as possible. But yeah, it is legitimately not an option for my clients to not give me their tax returns. That's just, yeah, part of our program.
Yeah, if you do a lot of tax planning, you got to get the return. It's like, I would say, probably the most important document. It's the Rosetta Stone into someone's financial situation, right? And Holistic Plan helps point that out, right? You can find out about accounts they may not have mentioned, businesses they own, different property sales, stuff like that, right? The big thing too, I saw a couple questions in here about kind of the tool, like the different tools we use. So ultimately the tax report is so easy to generate that we use it for the prospect, right? Because it doesn't take any time other than walking through it with them, but it's a good just way to show how you work. The other analysis does take more time. It takes longer to present. You typically like to spread it out between meetings, or have one meeting to talk about tax, one to talk about insurance protection. And then the tax letter is a whole separate time in January to walk through. And the tax letter is great with the tool of Holistic Plan because it's fully customizable. Right? You can create your own sections. You can use what they have. They're really good about adding sections. And two, with that, we used to do it on Word. So we were doing it on Word originally, and it was difficult to format, and it was hard to copy over. The one thing we found was actually from 24 to 25, we can just copy over all the data. So like once we put the accounts in once, it's there every year. So it was a huge, huge time saver for us to continue to do it year over year.
Absolutely. Yeah. I feel like there's been a lot of questions in the chat too, just about like how you structure this in your company, like how you charge for it, like how you bring it up to clients. So do you guys have any insight on like how you introduce this to your clients and the way that you present it to them?
Yeah, we've really built in our practice. Everybody's got a different structure. We've built in our planning, tax, retirement, estate, all of those services into our regular AUM fee. If a client has no assets or very, very little assets, we'll charge them a planning engagement for 12 months or on an ongoing basis until they've reached, a pretty low minimum. Get the question a lot, are you not losing money on these younger clients and doing all this planning with them? And yes and no, it's a little bit different. We've got a longer term outlook. These are clients that add money every year, and we get referrals up to their parents. They're doing insurance and other things. And so it's not necessarily, it's a long-term outlook for sure. But if we train them the correct way, if we educate them the correct way, that they turn into very good clients very quickly.
Yeah, I would 100% agree with that, right? A lot of when you work with retirees, right, you get to the point where they've built up their assets, they've got this huge base, right? And so when you're charging the AUM fees, that's what comes with it, right? If I'm going to charge a client, 1% on, $2 million, so they're going to be paying me $20,000 a year. I've got to be able to show that value, right? As Matt Jarvis always says, the value's got to be a certain multiple of what they paid you. And, there's a lot of value that you add as an advisor that's very difficult to quantify in dollars and cents, right? One of the easiest ones to do that is tax planning, right? By showing them, hey, by doing the tax planning, dollars and cents, here's how much we saved you, right? We've had clients where doing the tax planning, we've saved hundreds of thousands of dollars a year in tax filing. And I guarantee they take our advice and they're going to listen, right? And they're fine paying however much they want to pay to save that kind of money. We also sometimes, with business owners or people who don't have the assets, like he was saying, or people who have less or are really new clients, need a lot of planning, we'll do a planning fee, right? Or tax specific planning or something along those lines, right?
But yeah, to Finn's point, I mean, I charge more than the average, I think, because I include tax planning, I include all of these other things in our services. It's not enough, in my opinion, just to do investment and all of the people on this call know that if they're using the tools. But I would say, again, some CPAs do this type of planning, but the financial advisor is in such a unique position where we know what their retirement looks like. The CPA doesn't know that. We know what their goals between now and then are. The CPA doesn't know that. We very often are the ones directing their investment portfolio. So we're the ones just determining how much taxable dividends or interest or gains or whatever. The CPA doesn't know those things. And so in concert with the CPA, we have to take that active role of crafting the inputs that then go into that tax plan and everything else around it. And that's a tremendous value. Being able to add, hey, I saved you $500 on this little piece and $4,000 on that piece, and all of those things cobbled together. I mean, I don't ever have clients ask me about the fees ever. So.
Yeah, it all pays off in the end for them. They're not paying attention to what they're paying now. Yeah, another good question came up. So this could be for either of you guys, and you might answer differently to this because you have a different kind of clientele setup. But when you're building tax plans, do you feel like you're always projecting years and years in the future, or do you feel like you're more often doing the next, 1 to 2 years when you're planning for clients?
Yeah, so I would say when we're doing like very specific planning, right, scenario analysis, going through it very specifically, it is typically this, like the year we're planning for, right? So we're due 25, right? Occasionally we may throw in 26, right? So like if there's a one-time event in 25, we might want to see 26 to compare. But yeah, it is typically when it's that full scale, everything into it, that's what it looks like. The only big things we really look at planning over multiple years is Roth conversions, right? Because the Roth conversion is something that is going to take time to see the results, right? And with the retirees, a lot of the times, they may be in a low tax bracket, right? They may continue to be on that. They may not need the money, right? So doing the Roth conversion, they're like, oh, I don't need the money, yada, yada, yada. The big thing to also like to show them is saying, hey, by doing these Roth conversions, it's not necessarily 100% for you. It's also a gift for your beneficiaries, right? With the Secure Act 2.0, IRAs became the worst asset to inherit because of the 10-year rule. So if we say, hey, if they get inherited tax-free versus taxable, you're going to save your beneficiaries a lot on tax. So being able to show them and talk with them about, hey, projected tax savings over multiple lifetimes, it's really a big way to convince people to do conversions, because it's a lot of tax to pay up front, right? It can be a lot. And so having that conversation and providing them with the guidance and education is huge. That's also big too, by having the work to back up your recommendation. I saw a question, someone asking about, hey, I talked to a CPA and they kind of poo-pooed my idea, right, and shot it down. What do you do? The big thing is working with them as a partner. Say, hey, we're working for the same client. We're a partner. We're a team. Why? If you tell me that I don't need to do a Roth conversion for this client, why? Right? What's your research? Like, what's your analysis? What's your numbers? Right? What's backing it up? And a lot of time there's not something backing it up. Whereas if you have that, it's huge.
I'm trying to pay as little as I can this year. Yeah. Okay, then let's understand that. But what I'm trying to solve is a problem 10 years down the road, and they're not just not going to be able to see that. Yeah. And I would say very similar answer. We do our longer term forecasting in maybe the Roth conversion tool or in eMoney, but every year, I mean, is so different when you really get down to it. And so I don't want to try to make too many plans beyond next year. I'll show the impact of doing a donor advised fund over a couple year period, like a 2-year period, just to illustrate that point. But I don't want to do any specific forecasting for next year until we're into next year, because, oh, I just got a raise, or I got a bonus, or my RSU, my stock just doubled. It's all going to be moot by the time we're, get to that point. So focusing on the education and the principles, and then we will make adjustments all along the way to find whatever the right move is at the time.
Yeah, and I think talking taxes, I even get so throughout the year, you're going to talk taxes in every meeting, right? If it's tax loss harvesting, if it's distributions, if it's charitable giving, satisfying the RMD, right? Those are all tax conversations. But the big execution of tax planning items like Roth conversion stuff where it's big to see how the income is going to be variable. You run that plan at the beginning of the year, maybe when you get the return, but that plan's going to change, right? This year is as a prime example, right? A plan you ran in May is going to be completely different than a plan you run now because they passed a tax law in the middle of the year that added a bunch of changes for seniors, right? So typically we do the planning, but then the full execution of the Roth conversion, the execution of stuff, we typically don't do until the end of the year, right? We know what the tax laws are. We know what their income looks like. We know what their situation is going to be. So there's less variables at play.
Yeah, and we did a lot of the same thing the last couple of years. Make the plan in the beginning, check everything in the middle, really true it up, and execute at the end. But we took it one step further where, hey, if I did $100,000 Roth conversion for somebody in December, hey, what if we did 50 or 60 in January, the next week? And maybe we'll have room to do more, but I know we're going to do something. We don't know if the market will be up or down this year, but on average, it's up, in December compared to January. So let's start doing something in the beginning of the year and truing it up. So that way, and hey, lo and behold, on average, that'll be a good decision. Having converted something, get something on the books, and then there's less moving pieces to work out later on.
That's awesome, guys. We are right at time. But thank you so much for sharing, all that you had to give us today. It was a lot of good information in a short amount of time. And so we appreciate that. There are a lot of questions in the chat. Feel free to, go through and you can answer them, or we also can send out answers to those later after the keynote is done today. So if you didn't get your question answered, don't worry about that. We are going to take a short break before our next speakers come up. In the meantime, we know that some people had a hard time getting in the beginning. Do not worry about that. We're going to get you your CE credits. So we don't want anyone to be stressed about that. So I think we're going to put up a little background, Alana, and we will see you guys at noon.